Hello friends, this is Dr. Shashi Agarwal. I welcome you all. Today our topic is financial decision. Financial decision we means investment decisions, financing decision, dividend decisions and how they are interrelated. This topic is relevant for the student of corporate finance, financial management, also relevant for the student of plus 2 commerce, business studies. If you find my video useful, please do like it, share it, and also subscribe my channel Shashi Agarwal. So this is my app which you could download from the Google Play Store. This app provides free study material and free mock test to the student of commerce, economics and management. And we also have structured courses like business studies and financial management. So today our topic is investment, financing and dividend decision, how they are interrelated, comment and justify. First of all, we should be clear about what is the meaning of financial decision. When we talk about the financial decision, it means the decision which is related to the financial matters of a business. The objective of these decisions is to maximize the wealth of the shareholder, like which asset we are going to purchase, what what will be the pattern of capitalization, how we will decide about the capital structure, and how we are going to distribute the income. An efficient financial decision is that which increases the price of the share, whereas poor financial decision which will result in the reduction in the share price. Financial management is concerned with three broad decisions. Financial management means procurement of the funds as well as the effective utilization of the funds so that the wealth of the shareholder is maximized. And financial management is concerned with three broad decisions, that is the investment decision, financing decision and the dividend decision. We will understand them one by one. So first is investment decision. The investment decision is related to the determination of the total amount of asset which are to be held in the firm. An organization requires two kinds of asset. One is fixed asset and the other is current asset. The investment in fixed asset create the productive and earning capacity, and the investment in current asset is needed to run the business on daily basis. The composition of the asset and the business risk complexity of the firm perceived by the investor, that is taken into account. Since funds involve cost and the funds are limited, so that has to be utilized properly. Investment decisions are of two types: long-term investment decision and short-term investment decision. Long-term investment decision, which are also called the capital budgeting decision, they involve commitment of funds for long term. It is the process of making investment in fixed asset, which will create productive and earning capacity for the organization. These decisions, they are very important because they generate and influence the earning capacity and they involve huge amounts, so they have to be taken very rationally after a very careful planning because they are irreversible decisions. The finance manager has to assess the profitability of various projects before committing the funds. So they are evaluated before investing in them. The factors which affect the investment decision in long term, or we could say the capital budgeting decision: cash flow of the project. The cash flow from the project is taken into account before making any investment decision. The generation of cash flow from the project will influence the investment decision. How much cash inflow that project will generate? What will be the rate of return? The rate of return is very important because it possesses the strength of raising the value of the firm's wealth. And the investment criteria involved other things also, like nearness to the market, availability of raw material, availability of cheap labor, etc. Short-term investment decision, that is the putting funds in the current assets. Short-term investment decision, on the other hand, relate to the allocation of funds among cash equivalent, which could be converted into cash within less than 1 year. So these are also called working capital decision, because here the decision is related to allocation of funds among current assets, such as how much cash we have to keep in hand, cash at bank, how much we have to invest in inventory, how much we have to invest in the credit sale, receivable, and inventory. And working capital funds, they satisfy our day-to-day working, and these decisions, they affect the day-to-day working, liquidity, and profitability. So the organization has to take a sound working capital management decision which ensure efficient cash management, receivable management, and the inventory management. Efficient cash management means that we should have the sufficient cash funds in our hand to satisfy our short-term liabilities. And we should not tie up our funds in credit sales too much, and we should manage our receivable in an efficient manner. And there should be optimum investment in the inventory. Financing decisions are the decision about the quantum of finance that is to be raised from the various long-term sources and from the short-term sources. Because once we have taken the decision, the investment decision, then we are clear about how much total funds we require. Since firms regularly make new investment, so there is a need for financing, and financial decision, they are on continuous basis. Financial decision is not only concerned with how best to finance, but also concerned with overall mix of financing. Like we should get the funds at the overall cost should be minimum. Cost of capital should be minimum. Like while evaluating these are the sources, we have to evaluate the cost of capital also. The sources of funds for the long term are the owners funds. These are the permanent. Uh, these sources provide the funds on permanent basis. Like we could issue the equity shares, retained earning, and these are available on permanent basis. Borrowed fund, that could be in the form of debt. We could issue the debentures, bonds, short-term loan, long-term loan. These are the liability. Along with this liability, we have to make the payment of interest. Like the borrowed funds involve the repayment of interest as well as the principal amount. Whether we have profit or not, we have to make the payment of interest. But payment of interest on borrowed fund is a deductible expense. It reduces the tax liability. But there's always compulsion of interest and principal. That is, the financial risk is associated with it. A finance manager has to decide how much debt should be there, how much equity should be there. A mix of borrowed fund and owners fund. He has to take a rational decision. There should be optimum debt and equity mix. Finance manager has to decide how much funds from the borrowed sources and from the owned sources. What should be the ratio of the debt? What should be the ratio of the equity is the owners funds. Owners funds, they are available on permanent basis, but borrowed fund will be available from the different sources like the long-term sources, short-term sources, debentures and bonds. A finance manager has to decide a mix of owned funds and borrowed fund for the proper capital structure. Like while he's taking the decision, what are the sources from which we have to raise the funds? He will also keep in consider the overall cost of capital should be minimum. Dividend decision. Dividend refer to that part of the profit of the company which is distributed to the shareholders. A decision has to be taken how much should be paid as dividend and how much should be kept in the business in the form of retained earning, which will be useful for the exploiting the opportunities in the future. The high rate of dividend may raise the market price of the share and it will maximize the wealth of shareholder. But on the If we pay too much dividend and there will be less retained earning, when we are having growth opportunity, then we have to rely on the external sources for the fund. Investment decision, financing decision, and dividend decision, they all are interrelated and interdependent upon each other. They influence each other. The objective is to maximize the shareholders' wealth. All decisions, whether it is investment, whether it is financing, whether it is dividend, they are interrelated and interdependent upon each other. For taking the decision of investment, that cannot be taken until and unless we have sufficient availability of finance. For taking the decision of investment cannot be taken without availability of finance. These decisions, they are interrelated because the underlying objective is to maximize the wealth of the shareholder. The financing decision is in turn influenced by and also influence the dividend decision. In case the profits are retained for financing the profit, the availability of funds for dividend will be reduced. An efficient financial management has to consider and evaluate each of the decisions and what will be its impact on the shareholders' wealth. In the same, we have to strike the balance between the risk and return. Strike a balance between various sources so that the overall profitability of the firm and the market value should increase. So we have to, while taking the decision, we have to consider what is the expected return and what is the risk involved. How would decision influence the market value of the firm? So there should be a balance between the risk and return trade-off.